On Tuesday, the 22nd of October, 1907, a private railway car pulls into Jersey City Station. The man stepping out is 70 years old, gout-ridden, and the most important banker in the United States. His name is John Pierpont Morgan, and he has been called back from a Virginia vacation by a single telegram. The American banking system is collapsing. 22 trust companies have failed in 72 hours. Depositors are queuing for 10 blocks outside every major bank in Manhattan. The New York Stock Exchange is 2 hours from suspending trading for the first time in its history. There is no Federal Reserve to call. There is no central bank to stop the bleeding. The president, Theodore Roosevelt, is on a bear hunt in Louisiana and unreachable. For 3 weeks in October and November of 1907, the American financial system will be held together by one man, his private library on 36th Street, and $25 million of his own money. He will succeed. And in succeeding, he will prove to the United States Congress that the country can no longer be governed without a central bank. The Federal Reserve is born here. Pierpont Morgan, as he is called in childhood, grows up in Hartford, Connecticut. He is the son of Junius Spencer Morgan, who in 1854 moves to London to become a senior partner in George Peabody and Company, at that time the most important Anglo-American merchant bank. Pierpont arrives in London at 16, attends school in Switzerland, then Germany, and learns 5 languages. By 20, he is back in New York representing his father's bank. By 24, in 1861, he is placing the first major loan ever made by an American bank to the federal government, financing Lincoln's War. The Civil War transforms American finance. The federal government issues hundreds of millions of dollars in bonds. The Morgan House places more of them than any other firm. By 1871, Pierpont has founded Drexel, Morgan & Company in New York. By 1880, J.P. Morgan & Company is the dominant private bank in the country. In a nation with no central bank, no deposit insurance, no banking regulation worth the name, J.P. Morgan & Company has become something more than a private firm. It has become the institution the country calls when it cannot save itself. The American railroad boom of the 1870s and 1880s leaves behind something nobody planned for: bankruptcies, hundreds of them. By 1885, 30% of American track mileage is operating under court receivership. Lines built on debt no longer earn enough to pay their bond coupons. Bondholders sue, stockholders revolt, receivers fight each other in court. J.P. Morgan invents a solution that becomes a verb. He buys the bankrupt railroad. He wipes out the existing shareholders. He cuts the bond debt by negotiating a haircut with the bondholders. He installs his own directors. He merges the road with friendly lines to eliminate ruinous competition. He standardizes gauges, signaling, freight rates. The process is called Morganization. By 1900, J.P. Morgan & Company controls or has reorganized 40% of the railroad mileage in the United States. The collateral effect is even larger. Because Morgan has restructured the bonds of so many lines, his signature on a railroad's books is worth more than the railroad itself. Investors will buy any Morgan-backed paper. Investors will refuse any line he refuses to back. He has become, without anyone planning it, the credit rating agency, the underwriter, and the lender of last resort for the largest industry in America. In 1893, the United States Treasury runs out of gold. The country is on the gold standard, which legally requires the government to redeem paper dollars for gold sovereigns at a fixed rate. Speculators, sensing weakness after a series of bank failures, have been steadily presenting paper dollars at the Treasury and demanding gold. By early 1895, the Federal Gold Reserve has fallen below the minimum legal floor. President Grover Cleveland turns, in secret, to J.P. Morgan. The deal struck in the White House in February 1895 is the first private bailout of a national government in American history. Morgan and the Rothschilds, working as a private syndicate, will lend the United States Treasury $65 million in gold, raised by selling 30-year bonds in London and Paris. In return, they require an exclusive contract and a profit margin that Cleveland will be politically savage for accepting. The deal works. The Treasury restocks. The gold standard holds. But the lesson is the opposite of what Cleveland intended. A great democracy has just discovered that, in a real crisis, its monetary system is held together by one private banker. 12 years later, that fact will be tested again, this time without any contract at all. It begins with a failed copper short squeeze. In mid-October 1907, two brothers, F. Augustus and Otto Heinze, attempt to corner the market in United Copper Company stock. The attempt fails catastrophically. The brokerage firm financing them is wiped out within a day. The bank that supplied the brokerage, the Mercantile National, becomes solvent only on paper. Depositors notice. Within 72 hours, the panic spreads from Mercantile to Knickerbocker Trust, the third largest trust company in the country. On the morning of the 22nd of October, 18,000 depositors line up outside Knickerbocker's headquarters at 5th Avenue and 34th Street. By 2 in the afternoon, Knickerbocker has paid out $8 million in 3 hours and suspended payment. The next day, Trust Company of America is hit. The day after that, every other trust company in New York. The stock market opens and immediately begins falling. Brokerages call back their loans. Banks call back their loans to brokerages. The cascade is geometric. By Friday afternoon, the 25th of October, the New York Stock Exchange has called for an additional $25 million in cash to stay open. There is no $25 million. The exchange will close in 2 hours. It is the moment Morgan has been waiting for. For 3 weeks, J.P. Morgan operates from the library of his brownstone at 36th and Madison. The library has 2 rooms. The East Room holds Morgan, his telephone, and a few trusted lieutenants. The West Room, the larger one, lined with the world's greatest private collection of medieval manuscripts, holds every other major banker in New York. Morgan personally summons them: Pierpont, Stillman, Schiff, Baker, the presidents of every trust company in the city. They come because they have no choice. They sit on couches surrounded by Gutenberg Bibles and refuse to leave until Morgan has agreed they can. The first night, the 24th of October, Morgan tells them, "The New York Stock Exchange will not close. You will pool $25 million by midnight or every one of your banks dies tomorrow." They pool the money. The exchange survives the next day. The second night, Trust Company of America. The third night, the city of New York itself, which has run out of cash to meet payroll. Each time, Morgan locks the bankers in until they agree to fund the rescue. Reporters call it the bibliopanic, the banker who saves the country from his library. By the end of the third week, Morgan and his pool have moved roughly $85 million in emergency credit. The panic ends. The exchange has never closed. He has done what no central bank exists to do. He has been the central bank. The Aldrich-Vreeland Act passes Congress in May 1908, 6 months after the panic ends. It does 2 things. First, it authorizes emergency currency for future crises. Second, and more importantly, it creates a National Monetary Commission to study what kind of permanent central bank the United States needs. The commission is chaired by Senator Nelson Aldrich, who travels to Europe to study the Bank of England, the Banque de France, and the Reichsbank. In November 1910, he secretly meets 6 American bankers, including senior Morgan partners, on Jekyll Island, Georgia, to draft a blueprint. The result, with modifications, becomes the Federal Reserve Act, signed by Woodrow Wilson on the 23rd of December 1913. The Federal Reserve is, in structure, exactly what Morgan did in his library. 12 regional banks coordinated by a board in Washington, lending to commercial banks in panic, holding their bonds as collateral, expanding currency when the system seizes, contracting it when speculation grows wild. It is Morgan's library, distributed, codified, made permanent. J.P. Morgan himself dies on the 31st of March 1913 in Rome, 8 months before the act bearing his blueprint is signed. He never sees the Federal Reserve open its doors. His last words allegedly are, "I've got to go up the hill." The Federal Reserve has been tested by every modern financial crisis. Each test follows the same pattern Morgan ran from his library in 1907. In 1929, the Fed fails the test. It tightens credit instead of expanding it. The Great Depression follows, and Congress responds by adding the FDIC, Glass-Steagall, and the Securities Exchange Act. In 1987, the Fed succeeds. Alan Greenspan, the day after Black Monday, issues a one-sentence promise. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Markets stabilize inside a week. It is exactly Morgan's locked library promise made public. In 2008, the Fed runs Morgan's playbook again. Bear Stearns, Lehman, AIG. The Fed orchestrates emergency mergers, lends against junk collateral, expands its balance sheet by trillions of dollars. Every action a Morgan partner from 1907 would recognize. In 2020, the same playbook. Faster, bigger. Every crisis since 1907 has used the architecture Morgan invented from a private brownstone library. The most successful central bank in human history was designed, in essence, by a private banker who hated central banks. 22 years after Morgan's death, an Austrian-born economist named Ludwig von Mises tells a Treasury secretary that the only way to fix a depression is to let it burn. The secretary's name is Andrew Mellon. He is the third richest man in America. He owns Alcoa, Gulf Oil, and the Mellon National Bank. He believes with religious conviction that pain is the great cleanser. It is October 1929. The Federal Reserve, 15 years old, is about to be tested for the first time. The man advising it has just decided that the test should be allowed to destroy the economy. Empires of Money. Episode 6. Follow the money.